to introduce three topics: types of options, option positions, and underlying assets.
First, there are two types of options, call option and put option. A call option gives the holder of the option the right to buy an asset by a certain date for a certain price, while a put option gives the holder the right to sell an asset by a certain date for a certain price. There are several terms should be noted here. The date specified in the contract is known as the expiration date or the maturity date. The price specified in the contract is known as the exercise price or the strike price. We also know that there are two styles of options, American style and European style. American options can be exercised at any time up to the expiration date, whereas European options can be exercised only on the expiration date itself. It is noted that most of the options that are traded on exchanges are American. However, European options are generally easier to analyze than American options, and some of the properties of an American option are frequently deduced from those of its European counterpart. Next, we will move to the part of option positions. We have two types of positions, long and short, and two types of options, call and put. As a result, there are four types of option positions. A long position in a call option. A long position in a put option. A short position in a call option. A short position in a put option. It is often useful to characterize a European option in terms of its payoff to the purchaser of the option. The initial cost of the option is then not included in the calculation. If K is the strike price and ST is the final price of the underlying asset, the payoff from a long position in a European call option is max, STK, 0. This reflects the fact that the option will be exercised if STK and will not be exercised if STK. The payoff to the holder of a short position in the European call option is max, STK, 0, equals min, K, ST, 0. The payoff to the holder of a long position in a European put option is max, K, ST, 0, and the payoff from a short position in a European put option is max, K, ST, 0, equals min, STK, 0. The calculations of the payoffs from option positions will be showed in the following examples. We consider the situation of an investor who buys a European call option with a strike price of $100 to purchase 100 shares of a certain stock. Suppose that the current stock price is $98, the expiration date of the option is in 4 months, and the price of an option to purchase 1 share is $5. The initial investment is $500. Because the option is European, the investor can exercise only on the expiration date. If the stock price on this date is less than $100, the investor will clearly choose not to exercise. There is no point in buying for $100 a share that has a market value of less than $100. In these circumstances, the investor loses the whole of the initial investment of $500. If the stock price is above $100 on the expiration date, the option will be exercised. Suppose, for example, that the stock price is $115. How much profit the investor can earn from this call option? By exercising the option, the investor is able to buy 100 shares for $100 per share. If the shares are sold immediately, the investor makes a gain of $15 per share, or $1,500, ignoring transactions costs. When the initial cost of the option is taken into account, the net profit to the investor is $1,000. The figure shows how the investor's net profit or loss on an option to purchase 1 share varies with the final stock price in the example. It is important to realize that an investor sometimes exercises an option and makes a loss overall. Suppose that in the example the stock price is $102 at the expiration of the option. The investor would exercise the option contract for a gain of 100 times, $102 to $100, equals $200 and realize a loss overall of $300 when the initial cost of the option is taken into account. It is tempting to argue that the investor should not exercise the option in these circumstances. However, not exercising would lead to an overall loss of $500, which is worse than when the investor exercises. In general, call options should always be exercised at the expiration date if the stock price is above the strike price. There are two sides to every option contract. Similarly, we can calculate the payoff from holding a short position in call option. The figure shows the payoffs from holding the short position in the call option. Whereas the purchaser of a call option is hoping that the stock price will increase, the purchaser of a put option is hoping that it will decrease. Now we consider an investor who buys a European put option with a strike price of $70 to sell 100 shares of a certain stock. Suppose that the current stock price is $65. The expiration date of the option is in 3 months, and the price of an option to sell 1 share is $7. The initial investment is $700. Because the option is European, it will be exercised only if the stock price is below $70 on the expiration date. Suppose that the stock price is $55 on this date. How much profit the investor can earn from this put option? The investor can buy 100 shares for $55 per share and, under the terms of the put option, sell the same shares for $70 to realize a gain of $15 per share, or $1,500. Again, transactions costs are ignored. When the $700 initial cost of the option is taken into account, the investor's net profit is $800. There is no guarantee that the investor will make a gain. If the final stock price is above $70, the put option expires worthless, and the investor loses $700. This shows the way in which the investor's profit or loss on an option to sell 1 share varies with the terminal stock price in this example. The figure illustrates the payoffs from holding the short position in the put option. This slide illustrates the payoffs. Last part of this video will introduce several types of underlying assets, including stocks, currencies, stock indices, and futures. Stock options. Most trading in stock options is on exchanges. In the United States, the exchanges include the Chicago Board Options Exchange, NYSE Euronext, which acquired the American Stock Exchange in 2008, the International Securities Exchange, and the Boston Options Exchange. Options trade on several thousand different stocks. One contract gives the holder the right to buy or sell 100 shares at the specified strike price. This contract size is convenient because the shares themselves are normally traded in lots of 100. Foreign currency options. Most currency options trading is now in the over-the-counter market, but there is some exchange trading. Exchanges trading foreign currency options in the United States include Nasdaq OMX, which acquired the Philadelphia Stock Exchange in 2008. This exchange offers European-style contracts on a variety of different currencies. One contract is to buy or sell 10,000 units of a foreign currency, 1 million units in the case of the Japanese yen, for US dollars. Index options. Many different index options currently trade throughout the world in both the over-the-counter market and the exchange-traded market. The most popular exchange-traded contracts in the United States are those on the S&P 500 Index, SPX, the S&P 100 Index, OEX, the Nasdaq 100 Index, NDX, and the Dow Jones Industrial Index, DJX. All of these trade on the Chicago Board Options Exchange. Most of the contracts are European. An exception is the OEX contract on the S&P 100, which is American. One contract is usually to buy or sell 100 times the index at the specified strike price. Settlement is always in cash, rather than by delivering the portfolio underlying the index. Futures options. When an exchange trades a particular futures contract, It often also trades American options on that contract. The life of a futures option normally ends a short period of time before the expiration of trading in the underlying futures contract. When a call option is exercised, the holder's gain equals the excess of the futures price over the strike price. When a put option is exercised, the holder's gain equals the excess of the strike price over the futures price.